If you're holding stocks right now, bonds, a savings account, or really any investment at all, what I'm about to explain could either protect your wealth or leave you completely exposed to what's coming, because something very strange is happening in the markets that doesn't make any sense. The stock market just hit all-time highs while unemployment is climbing. This is backwards. It's like your car running better when you're out of gas. It defies basic economic logic. And understanding what's really happening could determine whether your investments survive the next major shift or get wiped out. I want to break down three critical things. First, why the stock market looks strong when the economy is weakening. Second, the three forces artificially propping everything up. And third, the specific steps you can take to position yourself before this house of cards shifts. By the end, you'll understand exactly how to protect and potentially grow your wealth no matter what happens next. Let me put this into perspective with hard numbers. In April 2025, the market crashed 5% in one day, then another 5% the next. $6.6 trillion of wealth disappeared in 48 hours. If you had $10,000 invested, you lost $1,000 in 2 days. Real money vanishing. Here's the weird part. Within weeks, all that money came back. By June, the market was higher than before the crash. Now we're at all-time highs, while unemployment is the highest in 4 years. The Federal Reserve has cut interest rates 3 times in a row, and the U.S. government is spending $2 trillion more per year than it takes in. $2 trillion. That's absolutely insane when you think about it. But here's what makes it worse. Companies like Nvidia are worth over $5 trillion, more than most countries' entire economies. And just 7 companies out of 500 in the S&P are responsible for almost all market gains over the last year. 7 companies holding up the entire market. That's an incredibly fragile foundation. These deficit numbers might seem abstract. What does it matter if it's $1 trillion more or less, right? For the average American household, this is equivalent to spending $266,000 more per year than you earn. Imagine putting that on credit cards year after year. How long before everything collapsed? Not very long at all. This isn't the first time we've seen this pattern, and that's why studying historical patterns matters so much. In the 1970s, we had stagflation. Prices up, jobs down. Getting sick and breaking your legs simultaneously. The stock market fell 50%. 10,000 invested became 5,000, taking years to recover. It was brutal for an entire generation of investors who lost decades of savings. Are we in stagflation now? Not yet, but we're seeing early warnings. Inflation elevated, unemployment rising. Same pattern as early 70s before everything fell apart. The parallels are uncomfortable if you know where to look. In 2000, the dot-com bubble. Everyone excited about the internet, the new technology that would change everything. Stock prices up based on spending, not earnings. Sound familiar? Like AI now. People said this time is different. Technology has fundamentally changed valuation models. Then it crashed and billions evaporated. The Nasdaq lost 78% of its value. Retirement accounts were devastated. 2008, the housing bubble. Banks taking hidden risks regular people couldn't see. Complex financial instruments, leverage on leverage, systemic corruption in rating agencies. More recently, Silicon Valley Bank, a top 10 U.S. bank, collapsed in 2023, shocking everyone. If a top 10 bank can fail overnight, what does that tell you about system stability? Every time markets rise while fundamentals weaken, History shows the same pattern. Eventually, reality catches up. The question isn't if, it's when. And more importantly, will you be positioned correctly when it happens? So what's the solution? Most think traditional approaches work. Let me explain why they don't, and why we're actually trapped in a system with no conventional exits. Print more money leads to hyperinflation. They will print more, quite a few trillion actually. Look at money supply data. 15 trillion in 2020 to 22 trillion now. 7 trillion added to the system. Almost 50% increase in just a few years. What happens when there's 50% more of something? It becomes worth 50% less. That's not complicated economics. It's simple supply and demand. And they'll continue, but can't do it extensively or it causes hyperinflation, like we saw in Zimbabwe or Weimar Germany, where people needed wheelbarrows of cash to buy bread. Cut spending? Politicians lose jobs. Never happening. Would you vote for someone cutting your Social Security, your Medicare, your benefits? Of course not. Social Security recipients would revolt, and politicians would be out immediately. This is why deficit spending is politically inevitable. No one gets elected promising austerity. Default on debt? Destroys dollars' reserve status. End of global financial system as we know it. No country would trust the U.S. again. Treasury bonds, considered the safest investment in the world, would become junk overnight. The entire foundation of global finance would crumble. Not going to happen voluntarily. Raise taxes? Voted out and wouldn't fix it anyway. If you confiscated 100% of every billionaire's wealth, took everything they own, it wouldn't make much dent in 36 trillion in debt. The math simply doesn't work. The problem is too big for taxation to solve. Grow the economy? Need 8 to 10% GDP growth for decades. Never happened in modern history. U.S. did a bit after World War II, when we were the only major economy not bombed to rubble. But it's not something that continues long term. 3% growth is considered excellent now. 8 to 10% sustained is fantasy. No traditional way out. But something's happening behind the scenes that Wall Street understands and regular investors don't. There's only one path making financial sense, already happening. The Federal Reserve artificially props up markets, not because the economy is healthy, but because it's sick, and they're desperately trying to prevent collapse. The Fed steps in when things look bad, cutting rates 3 times, giving the economy medicine because it's sick, not healthy. When you lower interest rates, borrowing becomes cheaper, companies invest more, consumers get cheaper loans. Historically, markets go up. But it's treating symptoms, not disease. It's like giving painkillers to someone with a broken leg instead of setting the bone. Feels better temporarily, but doesn't fix the underlying problem. Second thing institutions know, only 7 stocks hold up the entire market. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. If those 7 stumble, everything could fall. The other 493 companies in the S&P 500 barely matter to the index performance. That's not a healthy, diversified market. That's massive concentration risk that could unwind rapidly. Here's what separates institutional from regular investors. They understand systematic, pattern-based approaches around for 50 years. Why not taught in schools? Because there's a lot of money in keeping people uninformed, so they hand savings to advisors who charge fees while underperforming index funds. How this works. Fed cuts rates. Banks get cheaper money, lend more easily. Companies get more money, buy back stocks, which artificially inflates share prices. Consumers spend more, credit cheaper. all flows into stock market as artificial boost that has nothing to do with actual economic health or productivity. Government spending, $2 trillion more than taken in, spent on services, companies, infrastructure, weapons, subsidies. All those dollars flow into companies who pay other companies who pay other companies. Eventually ends up in stock market and asset prices. It's a circular flow that creates the illusion of growth while the underlying economy weakens. Artificial support from Fed spending, AI hype creating a speculative bubble, massive deficit spending. Markets rise while economy looks shaky. But warning signs people ignore because they're making money and don't want to question it. Inflation is hidden tax on everyone holding cash or fixed income. Even official 3%, which I believe understates reality, means losing 3% yearly. But look at actual prices. Housing up way more than 3% in most markets. Healthcare, education, food, energy, all up significantly more than official inflation numbers suggest. They manipulate the calculation to make it look better than reality. Over 10 years, 100,000 loses 25,000 purchasing power, holding cash at official inflation rates. But invested in right assets, 47,000 more. $72,000 difference between understanding this and not. That's the wealth transfer happening now. From those who hold dollars to those who hold real assets. From the uninformed to the informed. From the middle class to the wealthy who understand how the system actually works. Who wins? Stock owners in right stocks. Not all. S&P has 7 big winners, 493 mostly treading water or losing. Right real estate in growing markets with strong fundamentals. Commodities like gold and silver doing incredibly well as people flee devaluing currencies. Gold hit all-time highs recently, silver following. These are traditional inflation hedges that have protected wealth for thousands of years. Savings accounts, fixed bonds paying less than inflation, cash losing value daily, underperforming stocks? You're getting destroyed quietly, systematically, invisibly. Your account balance might look the same or even grow nominally, but your purchasing power is evaporating. Solution? Don't put all eggs in one basket. Everyone wants latest thing. AI will be transformative long-term, absolutely amazing technology, but taking way longer than hype suggests. We'll have disappointment period when reality doesn't match expectations, then back up over years as actual applications develop. Whether retiring next year or 30 years impacts how to handle this dramatically. Young people can take more risk. Older people need more protection. I have AI and tech exposure, absolutely, but diversify. Financial stocks positioned to benefit from certain scenarios. Metals as inflation protection. Biotech for growth potential. Solar for energy transition. Multiple sectors with different risk profiles and catalysts. Will these be what I hold in months? Not necessarily. Markets change, opportunities shift. Goal is, if latest thing drops, other holdings go up, providing portfolio stability and protection. Corporate bonds can work. Some pay 7% with reasonable risk for income-focused investors. Short duration bonds for emergency funds where you need stability and access. Long maturity bonds generally terrible. Inflation could destroy their value over time as rates potentially rise further. What you want. Emergency fund money in high-yield savings. Yes, it's losing to inflation, but it's liquid and accessible for true emergencies. 6 months expenses minimum, 12 months better. Some real assets, gold, silver, real estate if affordable. Physical assets with inherent value. Inflation hedges protecting if dollar loses value, which I believe it will regardless of who's Fed chair, because the structural problems are unsolvable through conventional means. Avoid what I see constantly. Portfolios 100% in latest thing. Concentrated risk bombs waiting to explode. Or 98 stocks all same sector, thinking that's diversification. It's not. That's concentration disguised as diversification. Buy 1 or 3 core positions per sector. Don't complicate unnecessarily. Worst thing? Waiting for crash before taking action. Given government spending and Fed support, traditional crash might not come. Instead, we might see slow, grinding inflation that destroys purchasing power invisibly over years. Powers that be don't want recession, too politically damaging. They'll keep propping up markets with whatever tools available. Don't fight it or waste energy complaining. Participate smartly while protecting downside. Bonus concept. If position is up significantly, set stop loss at reasonable level. Break even to protect principal, or 10 to 15% below depending on volatility and conviction. Key is never let big winner become loser. Take profits along the way. Let winners run but protect gains. I have losing positions sometimes. Everything goes up initially, then reverses. Exit with small loss because stop was set. When it crashed, rule triggered automatically, position closed, capital preserved. Cash to redeploy into better opportunities. Never want anchor tied around ankles swimming in shark-infested waters, which perfectly describes Wall Street. New Fed chair will be fascinating to watch. If supportive cutting rates aggressively, I'd increase stocks and precious metals. If hawkish, raising rates fighting inflation, I'd reduce stock exposure, especially speculative growth. Always trade with prevailing winds. Judge by where big institutional money flows. They move markets. Exit rules, not rigid recommendations, depend entirely on personal situation. Age, income, portfolio size, risk tolerance, investment timeline all matter enormously. But never letting winner become loser, adjusting for changing conditions, regular rebalancing, trimming winners, adding to losers, cutting losses before they become catastrophic, all extremely valuable practices regardless of specifics. When will market collapse? Can't predict exact timing. Nobody can consistently, but can see clearly when warning bells ring loud. Specific technical indicators, sentiment extremes, valuation metrics, all signal when risk is elevated significantly. Understanding these takes study and experience beyond quick explanation. We're at stretched valuations by historical standards. Peak AI hype with expectations potentially unrealistic. I'm still participating because opportunities exist, and sitting in cash guarantees losing to inflation. But also wary, maintaining strict risk management, automated stops, position sizing, diversification. Even if something unexpected happens, I'm protected from catastrophic loss. Review portfolio honestly. Identify concentration risk. Too much in one stock, sector, asset class. Make intelligent diversification moves. Bottom line simple. Warning signs flashing. If government wasn't spending trillions, if rates weren't suppressed artificially, we'd be in recession now. Powers that be desperately avoiding recession. Propping everything with available tools. Don't waste energy fighting unfairness. Participate intelligently, protecting downside while capturing upside. Most people fly blind. No roadmap, targets, exit strategy. That separates those preserving wealth through shifts from those wiped out. Knowledge and preparation make all the difference. History proves patterns repeat. Details change, but fundamental dynamics remain constant. Those understanding how institutional money flows, recognizing warnings, managing risk systematically, don't just survive, they profit. Wealth transfer accelerating. Which side are you on? Losing purchasing power in cash and bonds? Or positioned in real assets, maintaining value as currency debases? This determines your financial future. This isn't get rich quick. Understanding game being played, recognizing rules, positioning accordingly. House always wins eventually, but you improve odds by understanding how house operates. Protect yourself intelligently. Diversify thoughtfully. Implement proper risk management. Participate in the party. Just make sure you're not last standing when music stops. Because it will. Question is whether you'll be positioned to weather that storm when it comes.